Well, good afternoon, conference, and welcome back after lunch. This morning we discussed policy, and now we move into the business section, the business challenge. That's the theme of this afternoon's session, and we are delighted to have three highly respected speakers. We have Mark Beresford-Smith on my far right, Chief Economist of HSBC, Sean Roberts, Senior Partner of European Food and Farming Partnership, and we have Mr. Robert Law on my right-hand side, Farmer Extraordinaire from Hertfordshire. So we are delighted to invite the three speakers. The plan this afternoon is we'll have three presentations and then we'll have time for questions. As there are not too many questions come forward, please consider your questions and we will call for questions and we will use a roving mic if there is time. So to move on, can I first of all welcome Mr. Mark Beresford-Smith, and a very big thanks to Mark, because up until 3 weeks ago it was planned to have Mr. Vince Cable, Secretary of State at BIS, to our conference. He had to withdraw because of a ministerial meeting, high-powered ministerial meeting. So it's a big thank you for Mark to step in at very, very short notice. Mark needs no introduction as Senior Economist at HSBC. He is involved in advising the bank in the UK and its business customers on developments in the British and global economies, and he takes a particular interest in monitoring the performance of European countries, extremely important over the last couple of weeks, and also what's happening in China. So it gives me great pleasure to ask Mr. Mark Beresford-Smith to make his presentation, please. Over to you, Mark.
Good afternoon, everybody. Wakey, wakey, after lunch, yes, I know. I've got the graveyard slot, so I don't mind. Right. Anyway, it's a red letter day, isn't it? We've done the deal. Took all of 8 months. And so you see before you a cheerful economist. A rare specimen, I'll grant you. I am markedly more optimistic than I was 3 months ago. My absolute low point being Friday the 24th of November at a presentation just outside York at that Food and Environment Research place. Now, it wasn't my most depressed moment because it was a wet Friday in Yorkshire. It was because at that point the debt crisis looked as if it was genuinely about to engulf us all. 2011 was always going to be tough. We knew that right from the start. It was tough because it finally marked the point at which the advanced economies would have to stop stimulating their economies, would have to move from fiscal stimulus to fiscal austerity. That was inevitable. We knew that years ago. But it was made tougher by the commodity-inspired inflation, which made households poorer, which ate away at their incomes. And it was also made worse by a stream of other events. We start off with the Japanese earthquake and tsunami, which I think had bigger consequences for global supply chains than most of us thought. We then move on to the debt crisis. This had been rumbling on for a couple of years, and it had been said many times by me, among others, that either they need to sort this out or it will hurt. They didn't, and it did. So we rescue Greece, they rescue Ireland. They rescue Portugal. Nobody noticed that one. We got used to it. One rescue per country was fine. The problem is, it suddenly became apparent that we'd have to rescue Greece for a second time. And that turned out to be very big news. And that basically wrecked the rest of last year. And since May of last year has been spent trying to get a deal together that would at least stave off Greece's exit or its disorderly default. Give us at least a breathing space in which to work out what to do and get things sorted. Now we have that deal. But back in November, we got to the point where almost anything that us economists ever deal in, all those output numbers and GDP statistics and production numbers, all became worthless. Nothing mattered apart from the two numbers you see there. Italian and Spanish bond yields. That is it. And actually, today, it still is it. You don't need to know anything else. You don't need to know what the price of oil is. You don't need to know what the price of wheat is. You don't need to know what the economic growth rate is. All you need to know is those. If they're moving down, if they're comfortable, you can go home and sleep peacefully tonight. If they move up towards 7% and you get worried, and it doesn't matter in those circumstances what any other indicator tells you. Those are the ones that count. And the good news is that since November, they've moved in the right direction. I checked about half an hour ago. Italy was at 5.43. Spain was at 5.08. That's not great. It's not, it doesn't mean that they now have debt-sustainable futures. But it's an awful lot better than being close to 7% and the point where you will need to bail out countries that may be too big to be bailed out. So we're feeling rather easier about Italy and Spain. They're not worrying us in the way that they were. The debts, the bond yields have moved down, especially since the start of the year. And moreover, they are succeeding in going into the markets and raising finance in a fairly orderly fashion. The other reason we're getting so miserable back in November is that the infection had clearly spread to the core. It wasn't just Italy and Spain. It had gone right to the heart of Europe. It had gone to France, Austria. It had even gone to Germany. There was a brief few days when German bond yields were even higher than those in Britain, and that happens very, very rarely. That's why, ultimately, the last week in November was the most depressing time that I've ever had in 30 years of doing economics. What's happened since then? Well, yes, the politicians have worked some magic. We now have a more robust fiscal compact, and it is now called in the Eurozone, rather than that rather ramshackle, much maligned and much abused Stability and Growth Pact. That is very good news. But most of the work actually has been done behind the scenes by the technocrats, the guys that run the central banks. It starts on November the 30th, when they start to address the crying shortage of dollar liquidity in European banks. And they do that by arranging a swap line between the ECB, the Bank of England, and other European central banks with the Federal Reserve. That means that banks this side of the Atlantic, whether you be French, British, Scandinavian, can get access to dollars more cheaply than you could before, and you're not reliant on the whims of the market as to whether you can get them or not. It's one of those very small things, and certainly a long way away from doing whatever you might be doing in your fields where you're not here today. But it's those small things in the end that shape the progress of crises, whether they get worse or actually whether they start to abate. And it's from that point that the crisis starts to ease. Then the European Central Bank before Christmas makes a very bold move. It offers banks in Europe unlimited amounts of money, provided they can put up adequate collateral. And it offers them money for 3 years. There is no reason why any bank in Europe should now be short of cash. We should have no more failures like Dexia, because banks run out of liquidity. They all have enough, and moreover, there is another offering of 3-year money next week, and they may take as much again as they've already taken. We could have almost €1 trillion of 3-year liquidity out there. Now, what we're in effect doing is building what David Cameron called the big bazooka. It's not being built in the way that we thought we were going to build it. It was thought that it was going to be built by leveraging the European rescue funds, making them to about 2 trillion. Because what you need to understand about financial markets is they love big numbers. I don't mind too much how you get there. They just like them to be big. 2 trillion would be big enough. So we haven't done it in the way that they wanted us to do. And we've had to work around German opposition. The Germans in particular were dead set against the ECB buying up Spanish and Italian bonds. And as you can see there, those bond purchases that get going again in August sort of fade away under the onslaught of German resistance. But the ECB did another thing. It did these 3-year liquidity offerings instead. So you have next to 1 trillion that way. You have the rescue funds. The temporary one will be made permanent this year, and it may even be beefed up from 500 billion to 750. That's 1.75 trillion by my count, roughly. And then at a meeting this week in Mexico, they may increase the resources of the IMF by another 500 billion. It won't all be earmarked for Europe, but it could be. That, by my counting, is over 2 trillion. In other words, you've not done this neatly. It's not a tidy construction. Rather than building it openly, you've had to wheel it round the back so that the Germans wouldn't notice. Or so that at least they turn a blind eye. And there you are. It's a rather ungainly construction, but you have your big bazooka. And it might just be enough, and it might just work. But it doesn't resolve the underlying issue, as all of us know. The fact that Greece has a second rescue is very important. It gives us breathing space. But the mechanics of how a country sustains its debt are terribly simple. You have the outstanding burden of debt. You have the size of the country's economy in terms of its GDP and how that grows, or in Greece's case, does not grow. And you have the cost of servicing that debt. Greece has a debt burden of around 150% of GDP. It has a debt burden in monetary terms of about 350 billion euros. Its cost of servicing that debt is about 5% of GDP. The economy this year will contract by about 6%. That is not going to work. Either that economy has to grow and start growing quickly, or more of that debt is going to have to go away, or is going to have to be made much cheaper. Now, the private sector have already taken a big hit. The private sector have already basically written off half their debt. So the next time Greece needs to be rescued, the next restructurings will not be the private sector, it will be the public sector. It will be the European Central Bank, it will be the IMF, it will be the European Rescue Funds, it will be European national governments. In other words, they've now got a couple of years to save up, because it may be that they will not get back everything that Greece owes them, or they will not get it back with much or any interest. The HSBC view is quite firm. We believe the euro will survive, but I cannot guarantee you that it will survive intact as it is. I'm not one of those that thinks Greece will be forced out this year. And I think what the rescue has done has bought us plenty of time. If we do eventually have to say goodbye to Greece, far better that we do it, having thought about how to do it, albeit behind very closed doors, and albeit that by then we have managed to neutralise the contagion risk. We need to make sure that if Greece has to leave the euro, nobody thinks it then follows automatically that others have to go with them. That isn't going to happen this year. That's why I think this rescue buys us the time for us to work that one through. Okay, this debt crisis has obviously not had a great effect on the economy. It's been pretty rubbish, hasn't it? It works through two ways. Number one, it just makes us all feel miserable. As I keep telling everybody, my wife has banned me from watching the 10 o'clock news for about 6 months now. She takes the view that as I'm an economist, I ought to know what's going to be on it anyway. I'll just wait till she goes to bed and then I'll watch Newsnight. I'm even, as a rather tame bee, I'm even working up the temerity to ask that I might now be allowed to watch it since things have cheered up so much in the last few months. But that's what it does. It just makes everybody feel miserable. We just get fed up of it day in, day out. And actually, a lot improves, and a lot has improved, not because of anything tangible that's happened out there, but simply because this stuff is not over the news each and every day. It doesn't matter what takes its place, just so long as it is not the debt crisis. Just so long as we don't have to watch Robert anymore. Peston, I mean, not Laws. So, it also gets to us because it affects the banking system. The banks, over the last 6 months, have been starved of credit. An economy that gets starved of credit soon ends up on the brink of recession. And that's where we were. Fourth quarter of last year, we end up with a Eurozone economy that is actually contracting. Good news is that that process at least seems to have stabilised. Now, economists like these sorts of survey numbers. They're not very easy to interpret. They don't tell you straightforward percentages, up, down, or whatever. They report imbalances and then put the number as either side of 50, 50 being no change. But we like them because they are up to date, they are very quick, and we like them because they are surveys and therefore nobody comes and fiddles around with them afterwards like they do with our national official statistics. They will change in this country, they will change our numbers for up to 10 years. So when you see those headlines on the TV news, we'd have seen them towards the end of January. The UK economy grew by, or contracted by 0.2% in the fourth quarter. Don't take too much notice. It'll be wrong. They'll change it. But they'll change it when you're not looking, in about 18 months' time. So we look at these instead, these survey numbers, and the European numbers dip below 50 in September, very steeply, and it looks like we're about to fall off a cliff, and then things stabilise in December and January. So it's not great, but it looks at least as if things are no longer getting worse. The European economy is no longer contracting. Across the other side of the Atlantic, better news. America seems to have shaken off the debt blues. It seems to have realised that actually, although it is affected by the debt crisis, it's not in the direct firing line. Less than a fifth of everything America exports ends up in Europe. And Americans, I mean, it's too early yet to talk of a properly established housing market recovery, but the worst of that long nightmare seems finally to be over. And America is creating jobs, not as many as it would like. Of the 8 million lost in the recession, it's only made up about 2.5, but it is creating jobs, which is more than can be said for most of the rest of us.